What if I told you that your mortgage could be the biggest threat to your financial future when the real estate market crashes? With interest rates the most volatile that they've been in history and housing prices on the edge, millions of homeowners could be caught off guard. Will you be one of them? In this video, we'll break down exactly what happens to your mortgage during a market collapse and how you can protect your home and your money. You need to stay ahead of the game and safeguard your money. Let's get started. Okay, so in this video, we're going to discuss what happens to your mortgage when the real estate market collapses. Because most people don't realize this, but the steps that they take today could determine just how much they are affected when things go horribly wrong. But in order to protect ourselves, we need to understand what exactly causes a real estate market crash, how interest rates influence the market, and what you need to do as a result in order to protect yourself from the next big correction or crash. And as somebody who's owned a mortgage company for the last 20 years, I've seen both corrections and crashes that have impacted people in the worst ways possible. And many people falsely believe that a housing market correction isn't a big deal. If you have a mortgage, you can simply turn back the keys, the lender will sell the property, and you're off scot-free. But even if you are in a non-recourse state or a country, the damage that is done when your property goes into foreclosure is damage that will last a lifetime, not just from an immediate financial perspective, but also from the perspective of being able to buy another property anytime in the near future, and in some cases, even for the rest of your life. So let's start by understanding the economic impact on real estate. The real estate market is influenced by economic factors such as GDP, interest rates, and employment. The one that has the biggest effect is unemployment numbers. When things get bad in the economy and unemployment is on the rise, that is when the most damage happens in the real estate world. And it goes without saying that that same sort of downturn in the economy is usually what triggers a slowdown in the housing market. Because the housing market is what's known as a lag indicator. It's the thing that collapses after everything else gets bad. Very rarely is it the first domino in the series of dominoes that fall. In fact, quite often, it is the consumer confidence that happens as a result of other things in unrelated industries that plays a major role in the real estate buying decision. Because let's call a spade here. Nobody wants to buy a house when there's so much uncertainty around whether or not somebody will be able to afford it, or whether or not that decision to buy that house is going to be one that sees them in a position where their property is worth less than the amount that they owe, putting them in a state of financial hardship. Because when real estate values drop, and when they drop significantly like they do in a collapse, you may find yourself in a situation where you are underwater. What this means is that you owe more than the house is worth. And many people falsely think that it's better to just hand over the keys in this sort of situation. But that's not the case. In fact, handing back the keys to the lender can be one of the worst financial decisions that you make in your life. But I'm going to talk about that a little bit later. First, we need to talk about interest rates and housing. Because along with unemployment, along with bad things that happen in the economy, higher interest rates obviously make borrowing more expensive. And when borrowing gets more expensive, there are less people who actually want to buy a home, and this creates a ripple effect throughout the housing market. It reduces demand, and it causes housing prices to fall. And by the way, this doesn't happen nationally all at once. It happens in certain markets first, and then trickles throughout the rest of the country if things stay bad for long. But there are certain markets that will always outperform even when some markets are falling, which means that when we look at the housing market, we can't just look at it on a national scale. We have to look at it from the perspective of the market that we live in or the one that perhaps we're looking at moving to. And in general, the markets that do the best at any given time are the ones that have great employment, increasing demand for housing, and in most cases, significant amounts of migration to those cities. So in other words, even when the market is collapsing, it is the cities that have the most people moving to them, the cities that have the most job opportunities, and the cities that are the most affordable to live in that tend to do the best. Now, contrast that with places that are expensive to live, don't have a lot of jobs, and are just in general not the types of places that people move to when the economy is bad, and those are the ones that tend to fail first. 20 years ago, when I was studying economics, many people believed that San Diego was the canary in the coal mine. Whatever happened in San Diego tended to be what happened throughout the rest of the country next. It was the ground zero of what would happen in the real estate market. Now, in the current day, with all of the volatility in real estate, that is no longer necessarily true. But there are certain things, certain trends that you can watch in order to determine if your market is about to fall. But before we get into that, it can't be understated that there is a significant correlation between interest rates and the housing market. When interest rates are falling, the housing market tends to perform very, very well. And as we've seen since 2020, when interest rates start to rise and when they rise quickly, it tends to put a halt to what's going on in the real estate market. And in many cases, like in the 1980s, it can actually turn the entire real estate market on its heels. And there's a little known rule called the 1%, 10% rule. And the 1%, 10% rule can be applied in many different ways. A 1% increase in interest rates, for example, could mean a 10% reduction in buying power for borrowers. But it also means that when interest rates are increasing or decreasing, it creates a headwind in the housing market or a tailwind in the housing market that is exactly the equivalent of the change in buying power. So in other words, a 1% or 2% or 3% increase in interest rates represents a 10, 20, or 30% headwind to the market. Now, this doesn't necessarily mean that housing prices are going to come down 10, 20, or 30%, but in some cases, all else being equal, that could be exactly what it means. Now, of course, there's always other factors that come into play. You might have strong employment, or you might have weak employment, or you might have other things that are happening in an economy that cancels out that headwind or that tailwind, but interest rates play a significant role, and it cannot be understated how important they are when it comes to the real estate market. And by the way, increases in interest rates change the direction of the market significantly faster than reductions. As borrowers who potentially are looking to buy see interest rates go up, they will be less likely to buy. And that effect is almost immediate. But in contrast to that, when interest rates start to go down, people tend to sit on the sidelines and wait, hoping that they will continue to go down so that they can hopefully find the bottom of the market when interest rates hit the lowest point. So increases in interest rates affect the market quickly. Reductions in interest rates affect the market slowly. And in addition to that, usually reductions in interest rates mean that the economy is about to enter some sort of recession or already has, which means that more than likely incomes are shrinking, unemployment is going up, and there is already a declining effect on consumer confidence, which lower interest rates often will not cancel out. Now, of course, lower interest rates can make homes more affordable, but they can also create bubbles in the market. Look at what happened in 2020 when interest rates got near zero. Yes, we saw people moving their buying preferences up 2 or 3 years. We saw everyone entering the market thinking that if they didn't buy right now, they would never be able to afford a home. And that, of course, led to a significant increase in home prices. In many cases and in many markets, it actually priced people out of the market completely, which is why it's so important to monitor interest rate trends when considering buying or refinancing. Now, as much of a role as interest rates play in the housing market, the real factor that can affect a housing market and make it crash quickly is employment levels. Because employment levels are a double-edged sword. When unemployment increases, you'll see both decreased buying demand as people are unable to afford homes that they want to buy, but you'll also see potentially an increase in listings, an increase in inventory due to the people who already owned homes and could no longer afford them and either had to sell them or, in the worst case scenario, had to put them into foreclosure. And that combination of reduced demand with higher supply is what leads to significant market corrections, and in some cases, like in 2008, leads to a complete crash. And when you look at a chart of unemployment versus the housing market, you can see that the correlation is clear. Well, in this case, it's actually a negative correlation. When unemployment starts to rise, like it did in the 1990s, you see that the housing market starts to come down. Now, this isn't always true, because in the early 2000s, we saw unemployment start to rise, albeit it didn't get back to levels that were seen in the early 1990s. In fact, the unemployment levels of the early 2000s were very much in line with what you would expect them to be normally. But then take a look at what happens when 2008 rolls around. We see unemployment spike back to levels that were last seen in the 1980s, and obviously that created a pretty significant housing crash. Now, there was all kinds of things that led to this housing crisis, including the mortgage market meltdown. But at the end of the day, what really drives the crash is unemployment levels. It's when people can't afford the homes that they want to buy or can't afford the homes that they already live in that the market corrects the most. So the most important indicator when it comes to the housing market is in fact the unemployment rates. And not only do unemployment rates decrease demand and make it harder to be able to afford your home, but they also make it significantly harder to get a mortgage. Because when there's massive amounts of uncertainty around whether or not somebody is going to be able to work, lenders do not want to take the risk. In fact, in 2020 and 2021, we had a significant amount of clients that were airline pilots. And even though the rest of the economy was going okay and most of the job markets were starting to bounce back, the employment prospects for pilots were going down because travel across international borders was obviously restricted. And therefore, lenders were simply just not lending to anybody who worked in the airline industry because the risk for those people, even though they may currently have a job, was significantly higher than what it was for other industries. And there was one case in particular where we had a pilot approved for a mortgage. They had a 30-day closing. And even though he was adamant that he was safe and we were able to get the mortgage approved, before that 30 days was up, the inevitable happened and he lost his job. And I don't think I need to explain why it being more difficult to get a mortgage affects the real estate market in general. Less mortgages available, lower demand for housing, and things start to correct. So when things are good, lenders will loosen up their guidelines, do everything they can to capture more market share, and get really good mortgages on the books while they know that there's an opportunity to make money. But when things turn, they start to prioritize risk management to reduce defaults. And those tightening credit conditions are common as lenders try to avoid the bad loans so that they don't end up having to foreclose on properties and take on the risk of owning those themselves. So what ends up happening during a market crash is lenders require higher credit scores or larger down payments, which I'll get to why that is so important a little bit later on. But borrowers should be prepared for stricter lending criteria when the housing market is collapsing, which means that the time to prepare for a market crash is not while the crash is happening, but long before you ever find yourself in a situation where you're experiencing one. But let's say you do find yourself in a situation where you have a mortgage and the market's crashing. There are some things lenders are willing to do in order to avoid widespread foreclosures. They may offer things like loan modifications, which could include extending the loan terms or lowering interest rates, or in the worst of cases, things like forbearance or mortgage deferrals, so that you don't actually have to make the payment if you find yourself in a situation where you cannot make the payment. And by the way, before you miss a payment, the best thing to do is contact your lender because quite often, if you're open and upfront with them about what is going on, they have programs in place to assist you before you actually miss that first payment. And by the way, when you miss that first payment, it's going to affect your credit, which is going to affect your ability to get a mortgage in the future and could also affect the rates that you have to pay going forward, which could make housing costs significantly more expensive just because you missed one or two payments, or in the worst case scenario, actually went into foreclosure. And the key thing to remember here is that negotiating with lenders can prevent financial ruin. The earlier you do it, the better. And don't be afraid to be open and honest with what's happening in your personal finances, because at the end of the day, the lenders do not want to foreclose on borrowers. They would much rather have somebody continue to be able to own their home and make the payments than they would have to take that home out from under them and sell it. Now, if you are in a position where you can afford to refinance during a collapse, refinancing can actually be one of your biggest opportunities. If you are constantly monitoring interest rates and you see that interest rates get lower than what you are currently paying, there is always an opportunity to secure a better deal. Which, by the way, if you can get a 1% lower interest rate, that translates to about 10% lower costs over the life of your mortgage using that previously mentioned 1%, 10% rule. And if you can shave 2% off of your interest rate, well, that's a 20% reduction in your total costs. Because in the same way that it affects buying power, a 1% reduction in interest rates is a 10% reduction in the actual amount of interest that you'll pay over the life of your mortgage. And if you want to check the math on that with a mortgage calculator, be my guest, but the numbers are the numbers, and that is real. Now, of course, with tightening credit conditions, refinancing may not be an option for everybody. And by the way, if you are one of those people who doesn't have any savings and you're living at the edge, and you think that, oh, well, I've got a bunch of equity in my home, so I'll just refinance if I ever need to. Well, usually the times where you need to refinance, like during the time of a job loss, is when you can no longer actually get a refinance, which is why, again, it is important to act long before you actually need the money. Just like for our pilot friends who are getting the mortgages in 2020 and 2021, a mere 30 days can affect whether or not you'll be able to get that refinance or not. So you always want to be acutely aware of your personal finances, and you want to explore taking action before the financial stress sets in. And I'll say this one more time, acting proactively is critical to maximizing your refinancing opportunities. Now, when it comes to building home equity, this can be one of the best strategies to make sure that you don't find yourself in a situation where you're going to lose your home. But that doesn't mean you should be putting every last penny into your mortgage. You should always have some form of an emergency fund that is available to you without having to go to your lender and ask for it. But once you've got that emergency fund set aside, making extra payments on your mortgage not only saves you a significant amount of money, but it's also a risk-free way of saving money, and it allows you to build equity faster. And people often don't realize just how fast they can build their equity by making extra payments. And of course, having high equity positions can protect a homeowner from market fluctuations. If you have lots of home equity and the market drops 20 or 30%, but you've still got equity even after the market drops, well, at least you've got the ability to sell your property, pull a little bit of money out, and maybe rent for a while. But if your home gets underwater and you don't have cash available to you, the prospects of selling are zero, and you're either stuck with having to make the decision of keeping on making the payments that you perhaps can't afford, or turning the keys back to the lender, which again can be financially catastrophic. And of course, the more equity you have, the more opportunities you have for refinancing or loan modifications. But here's the key, it's all about financial preparedness. It's crucial during times of economic uncertainty. Establishing that previously mentioned emergency fund can help cover mortgage payments in tough times. And I'm not a big believer in having 3 months or 6 months worth of money available to you. I'm a big believer in having as much as humanly possible. And in an ideal world, everyone would have a year's worth of salary saved up and growing. And not only growing, but protected so that it wasn't invested in investments that could turn when the economy turns. If you want to know more about how to do that, make sure you check out my video on what always happens before a reverse market crash. But in addition to that, even though nobody does it, well, most people don't do it, regular budgeting and managing expenses can help homeowners anticipate and plan for financial challenges. Knowing exactly where you are every single month with respect to your finances is not only one of the smartest things that you can do, but it is also one of the most freeing, because financial preparedness reduces anxiety during downturns and helps you understand exactly where you are at and how protected you are from things like unemployment. But at the end of the day, weathering a market collapse comes down to what you do when things are good. And a lot of the times it has to do with what you're doing when you make the decision to buy a home in the first place. And with over 20 years of lending experience, lending to thousands of people, I can tell you right now, the most important thing that you can do when it comes to protecting your finances is avoiding buying at the limits of what you can afford. Just because a mortgage broker, a lender, a bank tells you you can afford X number of dollars in a mortgage doesn't mean that that is how much you should be borrowing. In fact, it is my personal belief that nobody should be borrowing at more than 75% of what they qualify for. So if you qualify for a maximum mortgage of $400,000, you shouldn't be borrowing more than $300,000. And if you qualify for a maximum mortgage of $1 million, you shouldn't be borrowing more than $750,000. Because it is, in my experience, the people who buy at their limits that are the ones that get hurt the most when things go bad. So when it comes to navigating a collapse, preparing in advance is critical to surviving a market collapse. And you have to ensure financial stability by making sure that you keep your borrowing in check and you save and you budget. And the homeowners who remain informed and act strategically are the ones that are most likely to navigate downturns successfully. The ones that have the emergency fund, haven't borrowed too much, and are prepared are the ones that survive a real estate meltdown. And most importantly, when the real estate market crashes, it is imperative that you avoid foreclosures if at all possible and at all costs. Because even non-recourse mortgages don't mean that you get off without any pain. Because even if you are in a non-recourse state, even if you have a non-recourse contract, if you miss 1, 2, 3 payments on your mortgage, it's going to affect your ability to borrow for a long period of time in the future. And if you end up going into foreclosure, it can often mean never getting a mortgage again. And if you don't believe me on this, just look at some of the people who in 2008, who to this day still cannot get a mortgage because they simply turned back the keys to their property. And by the way, even if you're underwater, it doesn't mean that it is the best decision to turn back the keys to the property. It is far better to weather out the storm. And if you've got additional funds and you can afford it, Instead of giving back the property that you've agreed to pay back the mortgage on already, go out and buy another one and get a deal. But don't think that you can make the amount of money that you're underwater just the bank's problem and get away with it. But at the end of the day, navigating a real estate collapse is completely and entirely within your control. Making sure you can afford the mortgage that you got initially, even when times are bad, making sure that you act before things get really stressful, and that you're proactive in your finances prevents you from going down with the ship. The more proactive you are and the more strategic you are, the better. Oh, and if you want to see what always happens right before a financial crisis, like the one in 2008, make sure you check out this video right here.